Welcome to another episode of the Straight Up Chicago Investor Podcast. I'm Tom Shellcross, licensed agent with Second City Real Estate. With me, as always, is Mark Ainley, founder and owner of GC Realty. Mark, I saw a ton of you this weekend.
Yeah, I know. It's just special shout out to Bree Schmidt and John Kasman and everyone that went behind setting up the Midwest networking real estate event, because it was a lot. So it's Monday, day after, and heck, I'm a little out of it too, just from talking so much or being just trying to be on all the time. So it was an awesome event, Tom. It's awesome hanging out with you. We got to chill for a little bit and hang out. What do you think about the event?
The event was good. Every time you leave one of those, at least for me, I walk out of there just feeling pumped, right? I walk out of there feeling pumped. I walk out of there feeling that I'm not doing enough. You hear like a Joe Fairless talk or, Jay Papple's on. It's like, all right, like there's still so much room to grow. And like the other thing is those guys seem so normal. You have an individual conversation. It's like, oh, this is like a guy who could be my neighbor. And it's like, he's got $2.7 billion under management.
I know. So yeah, two things. One,
so that next 6 unit doesning feel that hard.
No, it doesn't. But our network, you continue to see the same people year after year. So that network is important, and be able to tap or give into that network to be able to get something back is huge.
Yeah, the network, the knowledge. Our guest today, which we're going to get to, but I heard him speak at this 4 years ago about opportunity zones, and that's how I was able to set up one of mine. I had no idea what it was, or it was on my radar. I was like, oh, okay. And it's step one of, all right, let's figure this out. So, all right. Well, do we have a housing provider tip of the week?
We do, and it's not so much a housing provider, but it kind of stems off of what we're just talking about. One thing that everyone that was at the event these 2 days, or even if you only went one day, you specifically allocated time in your life for personal growth, and I think it's very important that it doesn't stop when you leave an event like that. And it's something you should have on your calendar on a daily basis, some sort of window of time that you're working, on your personal growth. Now, it's the difference of like working on your business versus in your business, and the business you're working on is yourself and helping yourself to grow. So when you are in the business, you're able to be more effective, grow faster, make decisions better, whatever it might be. So tip today is just make sure you're time blocking for individual growth time. Sometimes it's even, Keith Cunningham from the book we always quote, he always says thinking time. So it's very important.
All right. We have a heavy hitter alert today. So, Mark, super excited to have this guest back on the show.
Yeah.
Our guest today has leveraged decades of data science experience to build a highly efficient and profitable portfolio of over $1 billion across at least 10 states. If you haven't heard, he was with us all the way back at episode 26 and also episode 110. He's the CEO of Grow Capitus, the CEO of Multifamily University. He's also the CEO of his new Built to Rent company, which we're going to talk about. And again, we want to see what's new and what predictions he has for us. So without further ado, Neal Bawa, welcome back to the show.
Thanks for having me back, guys. It's terrific to be here, especially since I'm connected to you. I'm a client of GC Realty, so it's always good to be back.
Yep, we love having you.
Yeah. So Neal, let's jump in for last time we spoke, it was 18 months ago, and we were talking about we knew interest rates were going to most likely be on the rise. So you said, yep, you still felt cap rates were going to compress, just given that how much demand there was. Obviously it's some of that has played out true. Some of it's been probably a little bit different. Give us a synopsis for someone who's been in a hole. What has happened over the last 18 months, and what are some things that might have surprised you?
Sure. So firstly, that statement that I made turned out to be untrue. When I made it in a qualified sort of way, but I still, when I think about it, it's like, it's still wrong, right? I may have qualified it here and qualified it there. I'm not going to go into those qualifiers. But basically it was wrong. And the biggest reason for that is 18 months ago, when you read an analysis from Goldman Sachs or Wells Fargo or Bank of America, Merrill Lynch, all of the big guys, their feeling on where the Fed would need to go to stop inflation as of 18 months ago, which was just beginning to climb, was that the Fed might need to raise interest rates by 100 basis points or 200 basis points. And the worst case scenario at that point was in the 250 basis points. So at that point, I'm doing the math on 250 basis points and what that would mean for multifamily prices. And I felt like because the demand was so outrageous at that point, we might still see, continuing cap compression. As what's really happened to that point is that everyone in the marketplace, including the Federal Reserve itself, was wrong on the stickiness and the extent of inflation. So inflation in the United States um, peaked at 9.2%, and it peaked in a Q4 last year was when the peak of inflation was, and it's been coming down pretty nicely since then overall. So there've been months where people were a little disappointed, but overall it's been coming down pretty nicely. And the Fed itself expected that inflation would actually peak 6 to 9 months before it did. And that 6 to 9 months made a tremendous amount of difference to multifamily. And so today in multifamily, cap rates have uncompressed. I believe this is a temporary compression. Most people in the industry believe that the compression is or decompression is temporary. But for those people out there that don't do the cap rate math in their head, essentially, when cap rates decompress, right, or they rise, you see prices fall. So cap rates go up, prices go down. So we've seen cap rates go up by between 15 and 25%, right? And that means that prices have gone down by 15 to 25%, depending upon the market. So the most bubbly markets that had cap rates in the 3 cap range, Phoenix being an example of such a market, are the ones that have gone down, the prices have gone down as much as 25%. And some of the markets that were not very bubbly, which basically is the Rust Belt and also the Northeast of the United States, we've seen prices decline by about 15%. There's even markets that are in the 12% range, but I haven't seen any market decline less than 12%. And so a lot of it has been the extraordinary extent to which the Fed has had to go. So, we're recording this in May, and last week they raised interest rates by another quarter point, and I think that takes the Fed funds rate to 5.25%. At this point, there's fairly broad consensus that this is it. This is the top of the process. And now we're going to go through the plateauing process, which could be 3 to 6 months long. The Fed thinks it's 6 months. Wall Street thinks it's 2 months. We'll see who's right. But bottom line is, as a result of that, we've seen a significant reduction in multifamily prices. As I said, 15 to 25, with some markets pushing 30. And the surprise, the big surprise, Tom, has been the single family market, which has been extraordinarily resilient and has done really well. And now we are in the 3rd month of price recovery for the single family market, where prices have actually gone up. And I actually have a chart that I can read off to you on that because it's on my screen right now. But we have not seen any price recovery in multifamily. So we're still continuing to see prices drop.
Got it. So Neal, is that due to just the lack of supply in the single family market, and also that it's more lack of supply, therefore it's tied to comparables, therefore that's what's driving it, as opposed to the NOI number and having to cover your debt service? Or what's the rationale behind that? Like, why is that?
It's completely tied to a lack of supply, but the question is, why is there such an extraordinarily low amount of supply in the single family market? Clearly there's no real challenges with the market. It's reacting really well. And the answer is that the ultra low interest rates that people have on the single family market, with over 95% of all properties being under 4% fixed rates, has acted as a golden handcuff for that market. It's basically it's handcuffed the market. And I say golden handcuffs because it's good news for the market, because there hasn't been much price declines because of that. But that golden handcuff scenario is playing out in the single family market and supporting the single family market to a astonishing extent, to the point where, and I'm going to just read this off to you so you guys know, single family prices in the United States, that this is median home prices in the US, peaked at $413,000 in June of last year, so June of 2022. And they bottomed at $361,000 in January of this year, so January 2023. So that's about a 10-11% decline. Keep in mind that every year there's a decline. There's usually a 5% decline every single year, because that's just, summer peak versus winter trough. So this looks like 10%. It's really 5% when you adjust for the annual decline. And then since then, so that 361K was the decline. It's now actually up $14,000 from there in March. April numbers just came in. I don't remember what it was, but it was higher than the March number. So the single family market has seen recovery now for 3 straight months, and the recovery is sharp. It's not okay, we hit the bottom and now we're slowly going up. It's actually a sharp recovery that we've seen in February, March, and April of this year. So, and a lot of that just has to do with the fact that there's just an extraordinarily large percentage of those homes that are locked into interest rates. So essentially, the market is behaving as if the interest rates haven't gone up on the single family side.
So to be clear, though, what you're saying about the golden handcuff reference is that it's too good to let go. People they have these awesome interest rates, and they're not willing to, if they go sell now, their interest rate will be literally double.
Yeah, I mean, so they've seen prices drop, from June to December. That basically a 6 months of consecutive price drops. So they've heard that from their brokers, and they're hearing that it may not last. Interest rates will come back. The brokers are all saying, hey, the rates are going to go down at some point later this year or next year. So a lot of people are saying, if I need to sell, I'm still going to rent the unit out. So we're seeing a lot of people that would have sold their homes. Maybe they're moving from Chicago to Nashville. Well, they're not selling that Chicago home. They're basically putting it in the rental market because they believe that it makes sense to hold on to them for a year and a half. And from what I can see, I think most of them are right. So the bottom line is that it's that market is reacting in a very, very strong way. And that's been a bit of a surprise to me.
Yeah. So then tying this back to multifamily, is this one of the reasons why, at least here locally, we're still seeing strong rent growth, right? Prices might be going down. You're dealing with a harder debt service to cover, but in general, like it's still very easy to rent out units. And just anecdotally, I'm not data driven like you are here, but anecdotally, it's because, well, when you're in an A class or a B class, these people, they can't buy a home right now, so they're renting. Like the pool just seems to be larger.
So that, I think, is a localized phenomenon. So what we are seeing is that in the last 12 months, according to RD Matrix, rents in the United States for multifamily decreased by 0.4%. So that basically, in our world, by the way, we call that flat because 0.4% is such an incredible number. You don't know what to make of it. It's tiny. So as far as I'm concerned, rents across the United States have been flat. However, regional markets are significantly different, and Chicago actually is one of the markets that's done well with rents going up 3 to 4% a year. Whereas other markets such as Phoenix have seen rents decline the most. Phoenix has declined about 9 or 10%. Austin down about 2 or 3%. So there's a lot of expensive markets, including Californian markets, that are seeing rent declines. But the Rust Belt, Midwest have done really well. So has the Northeast. Of the hot markets in the United States, the traditional Southeast hot markets, the only one that is seeing significant rent increases is Florida. Otherwise, you're seeing sort of rents being pretty much flat. Anything from plus 2% to minus 2% is flat. And that's really the story of rents in the United States. Now, I want to finish that by saying this. When inflation is at 6%, if rents are flat, you've actually lost 6% rents. Okay. And I'll talk about why that is such an important, such a big deal, because traditionally we have not seen that happen in the 70s and 80s. So if rents are flat and inflation's at 6, you're actually losing ground.
Got it. One of your recent interviews, you compared this environment, or not compared, but talked about the inflation, how it spikes rents. You're comparing to the, called 75 to 84, whatever that time period was. What is different today, right? Compare that high inflation period to what we are going through right now.
Sure. So in the United States, rents tend to rise. Before the turn of the century, rents would rise at about 2% a year. So that was a pretty common number in most years. 2 to 3, and it was pretty consistent. You wouldn't get a lot of spikes in that, right? Now, before the 1974 oil crisis, those numbers were actually more 2%. So rents would go up 2% because inflation in the U.S. was very muted. From 1974 to 1984, a 11-year time frame, the United States experienced high inflation because of the oil crisis. So that's actually a very good viewpoint because we can use that data and say, how did rents do? How did multifamily do? How did single family do, right? And when I look back at that crisis, what I'm learning is, hey, some of the same stuff is happening again. Single family reacted really well. Prices fell in the 74, actually the 82 recession, prices fell for single family, and then 4 quarters later they were back right up. So they didn't really decline on a holistic basis. Now, what about rents? Well, rents were crazy high. So of those 10 years or 11 years from 1974 to 1984, the lowest that we saw rents in those 11 years was 6%. The highest was 12%. That's in a year, right? So essentially
compounding too, right? Like it's because it's year over year.
It's compounding, right? So well, inflation's also compounding. So I guess when you're comparing inflation to rents, you can't get the compounding effect because both are compounding. So bottom line though is what we have seen is that if I look at an 80-year time frame, including those 11 years of high inflation, rents in the United States tend to stay roughly 1% above inflation. So if inflation averages over 80 years, 2.5%, rents are going to be at 3.5%. So there's this delta above inflation that rents get. Why? Because during times of high inflation, things that you can get rid of, like that next car or like that, like buying a single family home, you defer those. But you can't really defer rent. Rent is basically like food. Rent, food, and gas are very difficult to defer. And so people basically pay a slightly higher delta than inflation. So we saw that very consistent. So very consistent across the last 80 years, very consistent during the only example that we have of consistent high inflation in the United States, 74 to 84, which tells us, this time it may be different. So let's discuss that, right? Because what we've seen is we've now seen 12 months of high inflation, averaging around 7%. So it peaked at 9. Right now it's more like 5. So the average has been 7% for the last 12 months. But there's 0% rent growth. Going by my old formula, I would have said, well, 7% inflation means 8% rent growth, right? So what happened to that 8%? We got none of it. And the short answer is it was there, but we got it a year early. So when I go back and look at the years before 1974, before the oil crisis, rents are in that 2% range. They're not going anywhere. They're just sitting there 2%, 2%, 2%, right? And then all of a sudden the oil crisis happens and they jump up. Well, in this case, though, we had an extraordinary spike in U.S. rents in 2021. So U.S. rents increased by 13 or 14% depending upon the market, in 2021. So we had this enormous spike and we are adjusting back. So the last 12 months has been the adjustment from that spike. So would I say this time it's different? No. We've just had to basically adjust from an extraordinary spike that made rents so unaffordable that we needed a year for salaries to catch up. The good news is this, okay? Normally what happens is the consumer really gets screwed because there's 6% inflation and salaries are going up by 3.5 or 4. But the United States is currently experiencing a once-in-a-generation manpower shortage in all kinds of things, especially in housing and new construction, but in all kinds of things. So here's the good news. Inflation's been up by 6 or 7%. Salaries have been up by 6 or 7%. So there has actually not been any loss of buying, ability for the average American consumer because, interestingly enough, blue-collar salaries are rising faster than white-collar salaries. So the last 12 months, something unusual has happened. It's the blue-collar people, the people working at Starbucks, the people working in construction jobs. Those are the people that are actually getting higher increases than the white-collar people whose salaries are rising, but they're not rising as fast as inflation. And those people make plenty of money. I don't think that they need it as badly as the blue-collar people. So the good news is we are now catching up. So if you had a year where your rents didn't go up, but your salary went up 6%, doesn't that mean that affordability ceiling that was hit 12 months earlier, now that ceiling's just a little bit higher. So you've got room to grow again. So I believe that we are going to see lower inflation in the next 12 months. Let's call it 3.5%, 4%. And I think we're going to see rent growth in that 3.5%. I don't think it's going to be higher than inflation. We're still catching up from that 2021 explosion, but I think we're going to see positive rent growth. So for April and March, the U.S. saw positive rent growth after rent declines for 10 consecutive months. So we're beginning to see the very beginning of that future rent growth. We're beginning to see it now. So rents are no longer falling.
Got it. So just a quick takeaway from that then, if you're a blue-collar person, you have this increase, most of that goes towards the rent though. Like, does that mean quality of life's getting worse? Like, it's not more of like a larger question outside of like our little business models, but it seems like all that extra money that is just going towards whether it be rent or rising gas price, like it seems, is that a true statement?
So over the last 12 months, it's not been true. If rents have risen by 0% and your salary has risen by 6%, none of the money that you've made the extra money that you made in the last 12 months went to rent. Now, again, regional differences. Chicago's seen, some rent increases. Other parts of the U.S. have seen decline. But as just looking at the American consumer, 200 million people, none of it has gone towards rent in the last 12 months. A ton of it has gone towards food and gas. So this time, food and gas have been basically the dominant pieces of that increase, where most of the increase that you have is going towards those. But there's also this misunderstanding. What I'm about to say is it really requires a little bit of focus, right? So there's this thinking that if your salary went up 5% in a year, you can only afford 5% higher rent. Actually, the answer is different. I mean, intuitively, it makes sense, right? If I make 5% more, then I should be able to assign 5% more in rent. I shouldn't be able to assign 6 or 7. People will say that is not something that is doable in the long run. In the short run, fine, you'll get 7%. But in the long run, if your salary goes up 5%, your rent can only go up 5%. Actually, this is not true, because it's very counterintuitive, and I'll explain it this way. So let's say you're a single renter and your income's $60,000, right? And you're paying 30% of that in rent. So you're paying $18,000 a year in rent, which is $1,500 a month. So you're renting a property for $1,500 a month. Now, let's say your income, just for the purposes of this example, went up 5%. So it went up from $60,000 to $63,000. That's 5%. So it went up $3,000, right? Now, what most people think is, yeah, well, he's paying 30% of his income for rent, so he's always going to pay 30% of his new $3,000 for rent. No, what's actually happening in the United States is 50% of that new money is going towards rent. Not 30, 50. Didn't happen in the last year, but if you look at the last 15 years, that's what's been happening. Half of all the new money that people make in America goes towards rent. The rest mostly goes towards food or goes towards, healthcare and gas. Healthcare, food, gas, rent. Those are really the four that are taking 100% of what people are making. So now you think about this. So out of that 3,000, it's not that he can afford $900 more in rent, which should be 30%. He can actually afford $1,500 more in rent. So his rent can now go up $600, right? And that's why rents in the United States can go up a little bit faster than salaries. If salaries are going up 5, rents can actually go up over 6, 7, 7.5. Can't go up 10 because that's not sustainable. That's something that most people don't understand, because there's this social justice feeling. Oh no, if my salary went up 4%, rent should only go up 4%. That's right. They should only go up 4%. But can they go up 5 or 6? The answer is yes, because you're spending half of all new increases on rent, and that's been consistent for the last decade.
Got it. So, Neal, that's a ton of information right there. So given all this, tie a bow on it, you're someone who's still active, you're still buying deals. How has your underwriting changed to what it was 18 months, 2 years ago, right? You analyze a deal across your table right now. What are some of the assumptions that you were making that you weren't making, call it 2 years ago?
I think the biggest assumption that I'm making today, which is pretty unpopular, I'm having trouble raising money for the first time in my career, to be honest. I've raised $280 million. I have 1,000 investors, is that there won't be significant cash flow. Because while I am in the camp of people that believe that as of May 2023, the Fed has done enough, has raised rates enough so that they don't need to raise them anymore. But I'm also in the camp of people that say there's really no hurry for the Fed to decrease rates. This is not one of those times when it's a peak up, peak down. And you might say, so you are saying this time it's different, man. And I'm saying this time is demonstrably different. By the time in previous cycles, the Feds got to the point where they were like, okay, this is enough, unemployment would already be around 5%. When the Fed started this cycle, unemployment was at 3.5%. As of yesterday, unemployment was at 3.4%. It's gone, unemployment. Instead of, there being more people unemployed, there's actually less people unemployed. After 12 months of pounding the crap out of the economy, there's actually still more people are employed, less people are unemployed. So this time is demonstrably different. And because it's demonstrably different, the Fed will take more time. The plateau at the top, which is usually 2 to 3 months, maybe as long as 6 or 7 months. And then the down curve, which is usually pretty sharp, especially in this case when rates have gone up very sharply, may actually be a slow, come down. So all of this is going to influence our underwriting. because that's really your question. How does that influence our underwriting? Well, cash flow looks truly, truly horrible for multifamily in the United States. If you use what I just said, if you're going to basically come up with bullish answers, then sure, cash flow looks great. But I'm seeing a lot of people buying apartments based on that. So I'm struggling. I'm losing offers. I haven't won anything, for a year and a half. There was one project that we got very lucky with, was a bounce back. But I'll leave that odd one out and say, look, since January of 2022 to May of this year, I've bought nothing because I can't make my numbers worth. It doesn't mean that multifamily is a bad buy. I'm not actually suggesting that, and I'll tell you why in a moment. But I think from a cash flow perspective, multifamily is really hammered at the moment because interest rates are so high that pretty much all of the profit that you're making is going into that mortgage payment. And I just don't think that that's going to really change for the next 12 months. So you've got to sell investors on the concept of, hey, you're going to have low cash flow for the first 12 months, and then still fairly low cash flow for the next 12 months. But you're getting prices that are 15 to 25% cheaper, and it makes sense to do that. And while that argument is a highly logical Warren Buffett argument, it's not finding a lot of takers amongst the investors.
As far as the pipeline goes, though, are you looking at a similar amount of properties and qualifying to call it your 20% you really drill down into it? How have those numbers changed overall in what you're actually looking at to buy?
In terms of how the numbers of, for purchase prices or volume?
No, volume, just the volume. So the number, obviously, if you bought zero in the last 16 months or whatever, compared to the previous 16 months, are you looking at an equal amount of deals, or is there just far less deals to look at? Or are you able to disqualify them because they kind of roll right off right away because they're not that good? Like, talk to us about kind of what deal flow looks like for you these last 16 months.
Deal flow is rising. So it's been very anemic for the last 7 or 8 months, very anemic, let's say down about 70%, 60, 70%. Now it looks like it's more down 30 or 40%. So once again, as of May 2023, deal flow is rising back up because but what I can tell you is most of the deals that are in the market have some kind of uniqueness to them. The most common being assumable loans. So the low interest rate deals where you can assume loans are favorites, and they're still getting 20 or 30 offers, money hard on day one, 4.5 cap rates. But if a property just doesn't have a way for people to assume those loans, those properties are in the in the 5.5 cap range. And they're still not selling because they still have, if you're getting 6% debt and 5.5 cap rate, you have negative cash flow. So those properties are still not selling, and they're staying in the market longer. So like everyone else, I'm trying to get to the properties that have assumable debt, and it's difficult.
Yep. One of the things I've started to see on OMs now is, OMs from someone, if I'm looking passively, they're saying, hey, like, we're going to make this cash flow by being at 40% LTV, right? We're just going to put in more money so we get this now. And then when rates drop, then we'll look to refi and recapture and recast, et cetera. Talk to us about that strategy. What are, some flaws you see in there? Are you a fan of that?
There's inherent flaws in that strategy, even though it is a pretty dominant strategy at this point. So you basically have to put in more equity at this point because the banks are giving you, a lower leverage. The question is this. You're an investor, Tom, right? So you're a passive investor and you're seeing what's happening the last 12 months. Your syndicators are keeping you apprised. Now, somebody's making this pitch to you. This pitch requires that as, things change over the next 18 months, there's no long-term impact to cap rates. How likely is that, though? I mean, is it likely that with all this crazy stuff that just happened, your expectations of cap rate in the future are going to be exactly what they were in 2021? No, your expectations of those cap rates are, hey, those cap rates are going to even in the future be affected because now investors have a recent memory that interest rates don't always stay low. Before, everyone was basically saying interest rates always stay low, that the last time they really went up was a very long time ago and blah, blah, blah. And no one can actually have that level of, collective amnesia. And because they can't, then buyers who are going to be buying these properties are probably not going to want to buy them for as much as they were willing to buy them in 2021. If you can't sell them for that much, Well, then you can't refinance them for that much. If you can't refinance them for that much, then 2 years from now, you might not be able to pull out as much data, as much money as you think you will. And so there's skepticism in the marketplace that we could simply get back to mean. I don't think we can get back to mean because the assumptions that we were making a few years ago were based on, ever low interest rates. And not only have we seen an inflation increase, it now seems that because of the world energy crisis that's coming up in the next 10 years, which I believe is the world's last energy crisis, we're going to actually see bouncy inflation throughout the world, nothing to do with the US.
Got it. Man, so do you see more opportunities coming then from some of these, call it bridge loans, right? Someone took out a 3-year IO, and they underwrote it at 4 or 5, whatever, and it's up at 7 now. Like, do you foresee that opportunity? That's what people keep saying, like, oh, there's going to be blood in the streets. There's going to be blood in the streets. Or do you think that's a small sample set of what's actually out there?
I'm in the camp of it's guaranteed that there will be blood in the streets. Now let's define blood in the streets because there's 2 different ways of defining it. And I'm only, I'm very specifically saying there will be blood in the streets from one perspective and there won't be. One way of defining blood in the streets is a significant number of properties go back to the bank. And because there's such a large number of properties going back to the banks, those banks then basically turn around and sell those properties in the general market. And so you get some discounting that happens there. I think it's absolutely 100% inevitable that happens, but it's going to be focused on certain extremely expensive markets. For example, I'm not going to see a lot of blood in the street in markets like Chicago, which are not, like the cap rates were not in the absurdly low levels. Phoenix is likely to see the most amount of, quote, blood in the street, where a bunch of properties go back to the bank and then they come back in the market and are sold at a discount. Now, the other definition of blood in the street is contagion, where basically prices start to fall simply because there's no financing available, there's no liquidity in the marketplace, and you just, you just can't refinance your property. We do not see that level of contagion happening. That is a 2008, 2009 sort of, event, and we don't see that happening at all. But we do see it happening for other asset classes. So for office and for retail, we see it happening. And we can talk more about that, but it's really tied back to the Silicon Valley Bank, crash and what happens to commercial liquidity after that. But keep in mind, multifamily does not have that challenge for one simple reason. Multifamily, the government has a mandate to provide loans for multifamily. Fannie Mae and Freddie Mac are extremely active, and because they've given out so few loans in the last 12 months, they have pots and pots of money. In fact, they're not even going to hit anywhere close to their limit. So they have lots and lots of loans that they can give out at the right price. So if you mean blood in the street means prices are going to go down, yes, I'm in that group. Prices are going to decline for multifamily in the next 12 months. Are they going to decline by catastrophic levels? No, because multifamily has lending available from Fannie Mae and Freddie Mac, and a huge amount of money is sitting on the sidelines, which at the appropriate point will come back, and we can talk about what that appropriate point is. That is not true for retail. That is not true for hotels. That is not true for office, because there is no mandate for governments to provide loans to commercial real estate outside of multifamily. So we should see in the next 24 months the greatest debacle in the history of the office market.
All right, you teased us. Let's go there, right? Well, what's the prediction here? I understand the concept. They don't have the Fannie and Freddie mandated loans. Everyone's gonna be gun shy about lending.
I think it's more than that, right? So if you look at multifamily, what is our historical occupancy level that we've had? It's 95. What is our current occupancy level in the United States? 94.6. So we've gone down basically 4/10 of a point, which is nothing, right? These are terrific numbers from a fundamentals perspective. Multifamily is in a great place. Rents haven't gone up in the last, 10 or 12 months. But apart from that one anomaly, which is related to the fact that they went up 15%, the 12 months before that, we're in a good space from a fundamentals and demand perspective. There's demand, there's fundamentals. And sure, you might see rents go down a little bit more, but fundamentals are strong. Office, though, is not in that space at all. There are significant numbers of companies that never return to the office, usually the smaller ones. The bigger ones, pretty much all of them returned back to the office, but instituted a 3-day work week, most commonly Monday and Friday at home, Tuesday, Wednesday, Thursday at work. So what they're doing is they're rejiggering their workspaces. So no one has the same cubicle that they used to have before. You come in on Tuesday, Wednesday, Thursday, you share a bunch of cubicles. As companies are rejiggering that space, they're finding that they're basically needing 30 to 40% less space. And if you take the office occupancy in the United States, which is today at 89%, typically tends to be around 92%, and you basically even drop that occupancy down from 92, the historic number, by 10%, almost all office loans in the United States would be unrefinanceable, and probably half of them would be in default. So the situation for them is unbelievably bad because there's no lender out there that wants to lend to office, and their occupancy keeps dropping. The only thing helping them, why you haven't heard about this as being extraordinary amount of gushing blood on the streets, is the fact that office leases are long. So the shortest office leases that I've seen are 3 years long, but typically they're 5, and some are 7, some are 10. So this is a extraordinary debacle that is moving at the speed of molasses. It's just very, very slow, but it's extremely predictable because we are not seeing any company say we're going to take the same amount of space that we had pre-COVID. Not one, no companies. All of them are slowing down. Google's slowing down. They're not building their huge San Jose facility. Apple is not stopped construction on that big facility in Raleigh. Every company, and some of them are basically giving up massive millions of square feet of space. So office as a asset class is in a World War II type crisis.
What does that asset class look like resetting? Like how you said that this will break down as lease terms end over the next handful of years. But where does the asset class go? Is there going to be a lot of repurposing where they got to just demo some of the older buildings? Like where do you see that industry going?
Well, I have really bad predictions on this. So from what I can tell, only about 5% of that empty space can be repurposed at a reasonable price. And I'll tell you why. Number one, if the office space was at $4 a square foot, let's call it $4 a square foot, and you're going to repurpose it to condos at $250 a square foot, well, how does that work? What mathematics makes that work? And repurposing is an extremely expensive process. So if you take a downtown office building and you're basically turning it into condos, you need tens of millions of dollars of loans from lenders who have no interest in giving you those loans because you've got two strikes against you. Your final condo price on a per square foot basis is lower than the office that you're converting, and you're putting tens of millions of dollars in. And then there's a third strike, which is that if all those office people go away, who's going to rent the condos, right? And we're not saying all of them will go away, but obviously downtowns already have tens of thousands of condos. And so you're adding to the supply of the condos. Well, you're adding the supply at the same time as that's the number of people that are going into the office is decreasing. So in a decreasing market, you don't add supply. So from what I can find, no one wants to finance these conversions. Lots of people are interested. Lots of people are talking about it. I'm seeing almost zero conversion volumes. There's small individual projects here and there that make sense where people are converting to hotels or converting to condos. But when I look at the total amount of free office space, if they get 5% of that converted in the next 5 years, I would still be amazed. I think it's going to be a couple percent.
You look at downtown Chicago, LaSalle Street, where they're talking about converting some of the old bank buildings into residential, but it's not possible without city subsidies and TIF money and so forth. So it's got to be a
massive
public-private joint venture even.
Massive. I think without cities jumping in and offering massive amounts of money, there's just no financial case that I see. And I think cities are already so hamstrung by what happened in the last 2 or 3 years that very, very few of them actually have the money. So a few brave cities will do muni bonds and that works out. Then maybe those cities will do well and there'll be some conversion. I think the biggest challenge is this. Most of the time, the only two conversion options are condos and hotels, right? And both of those are getting hit by the same phenomenon, the same work from home phenomenon. A lot of people say stuff to me like, why not convert it to industrial? Why not convert it to storage? And I kind of scratch my head going, so you're going to take something that is $4 a square foot and convert it to something that's 95 cents a square foot? How would that work out?
Yeah. So Neal, do you see any opportunity here knowing that's what's on the horizon? Like, do you see any play there? Like, is there something that you're lining up, or is this something you're staying clear from?
My feedback is this. We are all hardwired to see opportunity in every distress, but there are things where there is no opportunity. I think the office debacle has no opportunity. This is one where you remember in the 90s, this isn't true of every downtown, but many downtowns in the United States were pretty decrepit. There were lots of empty buildings. San Francisco is a perfect example, but Detroit. And then there was this comeback. There was this bounce back because of the dot-com bubble and then subsequent dot-com boosts, allowing for higher office prices, right? On a per square foot basis, rents went from $2 a square foot to 3 to 4 to San Francisco went to 5 and 10. And that allowed for a lot of things to happen in those downtowns that wouldn't have normally happened. This is now going backwards. I think it takes a decade to work itself out. During that time, I think people that are going into that are going to get wiped out. That's my belief. They're going to get wiped out.
Yeah, even Chicago's downtown was like that. Like a lot of people now don't realize how decrepit, call it Congress and LaSalle were, like that intersection. That what used to be kind of like the South Loop area. For anyone listening, like the downtown Chicago literally ended like at Roosevelt at most. That might be very aggressively south, but all that was pretty bad. All vice type district uses and then so forth.
We're going to see some of that. And if someone wants to actually study this, the market that is showing you the data that you will see across the United States is San Francisco. I mean, the stuff that is happening in San Francisco right now, because they're at 79% occupancy, where the rest of the US is at 89. So they had a bunch of mega leases, like 10 million square feet kind of leases where they basically didn't get renewed. And so those leases fell, those buildings went to basically zero occupancy. And then that made the entire market start to crash. And as that market crashed, more and more people moved out. So the market is basically showing you what will happen a year from now in other markets around the US. It's terrible. It's terrible. Where I live in the San Francisco Bay Area, and going to San Francisco was, something cool that you would do, once a month. We don't go there anymore. And Westfield, which is my favorite mall in San Francisco, I like it because I can go there by a train system, is closing down. So Nordstrom's already closed down. A bunch of other stores are closed down. And it looks like the mall itself is going to close down. At one point, it was one of the top 5 performing malls in the country.
Wow. That's a turnaround, man. So, all right. So, Neal, I do want to talk about built to rent here. So it looks like you've been super active in this space. Talk to us. What have you been up to? Why have you chosen this path? What are the fundamentals that you like about the built to rent sort of feature?
Well, I am extraordinarily bearish on the ability of single family builders to ever catch up on the single family shortage, right? Everyone knows, this is common knowledge. We have a shortage of single family homes in this country, and we've had a shortage basically all the way through this cycle, right? So, we were building a fair number of them in 2006, 2007, and then we basically didn't build much at all in 2008, 9, 10, 11, 12, 13. And then 14, it started to come back to be this huge hole. Well, when I look at that hole today, it's actually about the same. So we have made very little progress on that. And there's a lot of reasons for that. A lot of it is, high construction costs, lack of labor, the entry level home being, unavailable to most people. And that this was all before 2020. COVID made a radical change in that the average mortgage payment, even before interest rates went up, spiked because the US saw a 36% increase in prices, and many of the good markets in the US that are booming saw double that number. So 60-70% increases in prices, Austin being a perfect case. Now, some of those have retrenched. Austin and Phoenix retrenched by 10%. Other markets have retrenched by 5%. But if you go up 70 and retrench by 10, you still have a ridiculous affordability problem. So here's what I see. A lot of us in the multifamily market think of these other markets as being smaller. That's ridiculous. 62% of Americans live in single-family homes that they own, okay? 38% live in some form of multifamily. So multifamily is actually a smaller market than the single-family market. That 62% number, because of a combination of post-COVID price increases, ridiculous increases in construction costs, and a massive lack of construction labor in the United States. Even as of May 2023, we have a massive shortage. And that shortage is going to be a decade long because every year we have far more people retiring in construction than coming in. So the number of people retiring is like 3x what the people are coming in. So this isn't something that you fix in the short run, right? So the problem gets worse. And so now you have 62% of Americans living in single family homes down to about 50% in 15 years. That gap of 12% of Americans is a very large number of people. You're talking about possibly as much as 30 million adults in the United States simply not being able to afford a house because, their salaries have gone up 10% in the last 2 years, and the US average mortgage has gone up 88%, right? That 10% salary increase, 88% increase in mortgage. Now, some of that will retrench as interest rates come down. But I don't see any scenario that even if rates are down to 4%, if that number comes down from 88% below 40%. So obviously there's a huge gap there. A bunch of people can never go buy single family homes. I think we're going to, and by the way, this is not unusual. This is not unusual in countries. Look at Europe. Only rich people own single family homes in Europe, and really rich people. The middle class lives in these kind of townhome style buildings. You see hundreds of thousands of those buildings in Paris. You see hundreds of thousands of those in London. And these are rich cities, right? Everyone's walking around. People are throwing money around, but they're not living in single family homes. We had this access in the United States until we had cheap land, because the US built its freeway system when freeways were extraordinarily cheap. Most US freeways were built in the 50s, and then we've just been adding to them. Now, unless we spend $3 or $4 trillion adding new freeway rings around cities, the cheap land is gone. So you only have access to expensive land, and so you can't build as many single family homes. If you're not building them, and you're not building as many apartments as you need to, there needs to be what I call middle America, not workforce housing, because what multifamily does is workforce housing, and they should keep doing it. I think that's a great market. But what about the people above that workforce housing that used to own homes? The people whose incomes start at about $70,000 and go up to $100,000. That middle America no longer has the option of buying single family homes. Some of them will squeeze through, most of them won't. And so now people, developers such as me, are building build to rent housing. And we all started out in the wrong place where we started building a lot of single family homes. Then we realized we had the same problem. The homes were too expensive and we couldn't really build them at scale. And so we very quickly, the market changed tack and we basically started building smaller townhomes. So we went from, 2,000 square foot single family built to rent homes to 18 to 16 to 14 to now building 1,200 square foot townhomes that are, 3-bedroom, 2.5 bath with a pocket size front yard and a pocket size backyard. Now it seems that the market has agreed upon that and said, if you don't want to live in an apartment and you can't afford a single family home, this is that middle America piece. And I think we're going to build between 5 and 10 million BTRs in the next decade, build to rent people living in these townhomes. And that market is a very lucrative market because those tenants have more money. I always want a tenant that has more money. I want somebody that has $5,000 in their bank, not 500, because the people with 500, all of a sudden their car breaks down, they're not paying their rent because they still need to fix their car to go back to work. But people with $5,000 or $10,000 in the bank, they can see a disruption happen for 1 or 2 months and it doesn't bother you. So I am now very obsessed with the idea of building in these smaller markets where it's cheaper. Like in Idaho Falls, I just built beautiful townhomes, 1,300 square feet, 3-bedroom, 2.5 bath, postage stamp size backyard, nice front yard, amenities, some, not like pools and stuff like that, but amenities. And my rents in the peak of summer are $1,645 a month. People who make $60,000 can afford this property and they can live in a beautiful home with nobody running down the corridors, no gunshots. They're in a townhome community. Built to rent is an evolution of single family construction in the United States. And it is a massive evolution. I think that's where the money is for the next 10 years.
That's awesome. Neal, do you mind sharing, if you don't want to, you don't have to, what does that cost? Like, is there a price per square foot that you guys follow? Like, we hear the 1645, like roughly what does it take to get there?
So in we usually build them in fourplexes, right? So a fourplex is a pretty, efficient model. So you have 4 townhomes, so 2 in the middle, 2 on the side. The ones that are on the sides are probably 1695, right? You get $50 more for being on the side. And we're able to build them for as little as 800,000 for 4 units. So that's $200,000 a unit, all in, right? That's our all in cost, including land and everything else. And in other places, it's costing us as much as 350,000 per unit. So it really, that variation really depends on where in a city, how big is that city, how fancy do you want to make it? Do you want to add a pool? Those kinds of things. Do you have a gym? So it's all in the 200,000 to 350,000 dollar range. I think more and more builders will start to push towards that 200,000 per unit range. In terms of cost, obviously you're selling them at a higher number.
Got it. No, as you say this, we own a lot in, call it like the A class here, and it's not the same as the build to rent, but it's some of the same fundamentals you just mentioned, right? Like the people, anything happens wrong, it's like, hey, right? It doesn't matter. They can live with it.
Right. My units with you are like that. So, I think that the rents in Chicago obviously are lower than most parts of the US, especially because I own on the south side, which has a different feel from the north side. And so my rents right now are, for 3-bed, 2.5-bath townhome style construction. It's really an apartment, but it's got a townhome feel to it. And there was a 2005 built building that I have with GC, and the rents are in the 1400s.
Yep, 1400. Yep.
Right. So most other places in the U.S., those rents are in the 1600 space. But what's nice is a townhome actually has a backyard, whereas my units in Chicago don't have backyards. They have sort of a backyard sort of feel because a building might have 2 or 3 tenants as opposed to having 20 tenants in an apartment.
Yeah.
So they have significant townhome-like benefits, but they're not quite townhomes. So you're going to pay a couple $100 more for that. So if we can basically build so that we're renting out, and the example I gave you, 1645, I think is a best case example. Most places in the U.S. we're targeting people renting at 1,800 to 2,000. For 3-bedroom units and a little bit less for 2-bed townhome. And wherever we can build them, I'm going to build as many as I can, because I think that is the new single-family home in the U.S.
Awesome stuff. All right, before we wrap, I want to ask about tokenization, because that was a hot topic last time we spoke. Is that something that's still heavy on your radar? What's your prediction? What has been different or unexpected from the last time we spoke?
Completely changed my mind on it for one simple reason. I think the idea remains just as wonderful as it was. The ability to take real estate and tokenize it, break it into pieces, and democratize it. I wouldn't put a single, second of my time into it because of the Securities and Exchange Commission crackdown. They've made it extremely clear that there are no waivers for tokenization, that there are no loopholes, that they are not writing new laws to adopt tokenization. And so everyone that is operating right now is operating in an extremely gray space or just is ignoring the law. And while you can ignore the law for a while, it seems that the SEC is now enforcing. They saw what happened with the FTX exchange. They've been sending lawsuits to Binance. So what is happening is that marketplace I was banking on tokenization eventually seeing some kind of rationalization from the Securities and Exchange Commission where they're saying, okay, here are some new rules and you guys need to follow these rules and then you don't have to follow all the other rules, right? That's what happened to the 506c space in 2014, where the SEC came back with new rules. We are not seeing that happen at all. The SEC says, you sell a token for $1, you're selling a security. And we do not have new rules to support that. So until the SEC changes that point of view, anyone that's doing it is risking everything. So I feel sad about it, by the way, because I think it's a tremendous opportunity, but you have an extremely hostile, Securities and Exchange Commission.
Got
it. We'll keep our eyes out for that, though. We'll ask you in 18 months.
All right. You ready to wrap, Neal? I got some questions. I changed them up a little because you've asked them before. You ready?
Sure. Yep.
All right. Last 18 months, what's your competitive advantage? How are you able to pivot in what you do when others wish they could?
In my case, because I'm a developer, I'm able to pivot to going into very small metros that have low construction costs and basically building. And so that's not putting too much pressure on me to keep buying value adds when their values fall, 1 to 2% a month. I'm waiting.
Love it. Patience time.
Well, you mentioned those costs. I was like, ooh, that is much lower than Chicago costs.
Yeah.
When you're mentioning the price per square foot there, those are very attractive numbers to me. All right, so we have a lot of investors who want to get in the game. What is one piece of advice you would tell someone? They're just starting out their journey right now. They want to jump in. Supply is low. What advice would you give to that individual?
Why are you afraid today? I think that you're all going to make the same mistake that you made in 2009, where you froze. And yes, 2009 was extraordinarily bad news, but is there a person here that's living today that would not have jumped into the 2009 real estate market if they knew what was going to happen? They all would have, right? But today you're afraid, even though it's clear that fundamentals are very strong and prices have already dropped. I mean, single family prices have dropped in many markets in the US by 10%, so you get 10% cuts. Multifamily prices have dropped by 15 to 25%. If you like big discounts, go to Phoenix, buy today. Why are you okay with why do you have to time the bottom of this market? You're already receiving discounts. People are still fearful. You should be greedy.
Love it. All right. What these days, what are you doing for fun?
Boy, I'm just traveling the world. So I'm at the point where my boys are older. So I spend 3 to 4 weeks a year in Europe and 3 to 4 weeks in Asia, just roaming around the world. I'm at that point in my life because I just turned 50.
Nice. So happy birthday.
Congrats.
Thank you.
All right. So, Neal, please give us either a good book, podcast, or a self-development activity that you'd recommend to our listeners.
Good book, Miracle Morning, because it allows you to find your best book. It may not be your favorite book. It's actually not my favorite book, but it's the most effective way for you to get to that favorite book that changes your life. So Miracle Morning. Podcast, I think I do a lot of good ones. So I'm going to simply say, type in Neal Bawa Pod Chaser and you'll see 200 podcasts that I've appeared on. I don't actually have a podcast of my own. Never want to start one. I'm very lazy. But if you type in Neal space Bawa space Pod Chaser, you'll see a couple hundred podcasts that I've appeared on. I'm known for my blunt opinions, and I'm happy to just agree when I'm wrong. So you might want to check out some of the more recent ones. One other thing that I would suggest that you check out is keep an eye on what's happening in the climate change arena, because it's creating radical profits in many markets that are outside of real estate.
Awesome. Yeah, podcasts are like boats. Boats are better off having friends that have boats and not having your own boat. So, all right. Besides yourself, name one person you'd highly recommend to other investors as a quality resource, either online or in real life.
That's interesting. Who would I recommend? As an investing resource, I'll still go back to Warren Buffett, because you know what? The guy keeps saying the right stuff. Everyone keeps quoting him. Nobody listens to him. So please, for God's sake, listen to what he's saying.
Awesome. All right, we'll put his contact information in the show notes.
That's right.
W Buffett at. All right, Neal, thank you so much. You provide a ton of value to our listeners. How can they learn more about you, and is there any way they can provide value to you?
Sure. Easy. I'm easy to find. I'm the only Neal Bawa on the World Wide Web. So simply type in my first name and last name and hit enter on Google. You'll find your way to me. If you want access to all of our structured content, we do not have a podcast, but we provide 12 very powerful webinars each year, and 25,000 people attend those webinars. They're nerds and geeks like us. Those webinars are all at multifamilyu.com. That's multifamily followed by the letter u.com. It is a free website. There's no subscription. There's no education, upsell. We just share things that we are interested in. Coming up in the next 2 months, one is basically a webinar that talks about the commercial non-multifamily markets debacle in the next 24 months. We believe that's going to start. And the second is our fundamental belief that artificial intelligence is the greatest change in the history of mankind. And so we'll spend an hour talking about how AI changes everything. Everything's touched in a way that is difficult to even imagine. So those are 2 webinars that are coming up.
Awesome.
Great. We'll post both those in the show notes. And I can speak just from firsthand, like the amount of content that you put out, it's phenomenal. The webinars, the slide shares, the OMs, the examples, like it's all there. You should be charging for it. I'm glad you don't. Just personally, it's something that I leverage all the time. So I encourage our listeners to get on there. So
Sounds good. I'm glad you like it.
all right, so you're not off the hook yet. We have our Chicago facts here. So Mark, who are we playing for? Mark will get first shot at this. Then Neal will give you a shot as well.
All right, playing for Debbie Denton out of Oak Park. So Debbie, if I get this right, you'll win a $50 gift card brought to you by NEGC. Matt Nassau.
All right, awesome. So I didn't, Neal's not a local here, so I wanted to make this more of a math question. This is almost like an SAT, ACT type question, Mark. So there's roughly 135 hotel rooms in the central business district. According to our census, roughly how many available hotel rooms? So there's 135 hotels. How many hotel rooms are available in Chicago's central business district? And your options are 6,000, 16,000, 27,000, 44,000.
What was A?
6,000.
I'm going with 6,000.
I'm going to go with 6,000 as well. So you'll have a tie.
Oh man, guys, maybe I misrepresented the question. It's 44,000.
44,000.
Whoa, that is a lot of hotel rooms. Okay.
We got some big
stunning,
ones, guys. You got
I guess you have to have some big ones. All right. Well, Debbie, I apologize, but I'm gonna make Matt Nozzle at NEGC send you out that $50 gift card either way. So, Matt,
to be clear, my source was the internet, so it's absolutely the right answer.
Yeah, for sure. So, Debbie, you're lucky. You're lucky. He gave us a really difficult question. I actually feel bad making you lose on. So, Debbie will send you out a $50 gift card brought to you by NEGC. And Neal, thank you for coming back on. This is your third time, man. So 2 more, you get to be in the 5-timer club. And Tom, thank you as always, listeners. We're planning for our networking event this summer, Fiesta on 47th. So we're getting excited about that. It's going to be limited space at this event. So watch the website, straightupchicagoinvestor.com for updates. So thank you, Neal, for coming on. And Tom, thank you as always, listeners. We'll see you next week.
Thanks all.
Thank you.